Welcome back to the Explainer. Today we're diving deep into a completely specialized analytical deconstruction of the 2025 Adoption Financial Framework. Now we're stripping away all the surface level fluff here. Instead, we're relying entirely on a comprehensive, anonymous expert report to break down the exact mathematical mechanisms, the really strict compliance rules, and some hidden strategies you definitely need to know. If you're just looking for a generic, high-level summary, well, you're probably in the wrong place. We're going to map out exactly how this system works under the hood, highlighting those actionable insights and critical cause and effect relationships. So let's just dive right in. Okay, so the single most fundamental policy shift happening in 2025 is the move from a strictly non-refundable benefit to a dynamic hybrid financial model. Think about how this used to work. For years, the framework operated on a singular track, right? If you didn't actually owe any federal taxes, this financial benefit was literally inaccessible to you. It only existed to offset your existing tax liabilities. But according to expert analysis, that rigid structure has totally been overhauled. Now, we're dealing with a dynamic hybrid mechanism that fundamentally changes the financial math for families. It actually unlocks capital regardless of what your baseline tax burden looks like. This is a massive paradigm shift, guys, because it introduces direct liquidity into the process, rather than just erasing an existing tax debt. And right here is the exact numerical threshold driving this entire new framework: $17,280. This is the absolute upper limit of capital available per individual child. As we go through the rest of this explainer, you really need to keep this specific number in the back of your mind. Why? Because every single calculation, every deduction, and every strategic exclusion we're about to look at mathematically anchors right back to this hard ceiling. It's essentially the gravitational center for every financial decision you make during the adoption process. All right, here is our roadmap for today. We're systematically building this out, starting with the 2025 hybrid structure, then hitting eligibility and income thresholds, mapping out the employer benefit interplay, uncovering the special needs exemption, decoding strategic claim timing rules, and finishing up with carry forwards and sequencing. Let's keep moving. Section 1, the 2025 hybrid structure. Let's get right into the math of how this dual limit system operates in practice. So that $17,280 ceiling we just talked about, it's now fractured into two totally distinct buckets. Up to $5,000 is now officially designated as the refundable portion. In practical terms, what does that mean for you? It means that even if a family has an absolute zero tax liability, they are mathematically guaranteed access to this $5,000 as a direct cash refund, no tax debt required. The remaining $12,280 makes up the non-refundable portion. Now, this part functions under the traditional rules. It exists strictly to offset existing tax burdens. This bifurcation is a really huge deal. It completely changes how you approach strategic financial planning because you're now juggling two separate classifications of capital, and they have entirely different liquidity profiles. Now, here is a critical and honestly often misunderstood pattern within this framework. The credit amount applies to the adoption of each child individually, not each calendar year. I'll say that again because it's absolutely crucial. The $17,280 ceiling is a per-child maximum. It is not an annual renewable resource. So let's say you have a really complex adoption that spans across 3 different calendar years. You do not get a brand new $17,280 limit every January. The expenses from year 1, year 2, and year 3 all cumulatively drain from that exact same single reservoir. This severely impacts multi-year strategic planning. You have to meticulously track your expenses over time to make absolutely sure you don't exhaust that cap prematurely. Moving right along to Section 2, eligibility and income thresholds. Let's look at the strict gatekeepers for this mechanism. The precise modified adjusted gross income, or MAGI, phase-out brackets for 2025 act as incredibly rigid gatekeepers here. Look at these numbers. If your MAGI is under $259,190, you have full access to the framework, the whole shebang. But the very second your income hits $259,191, the benefit drops into a mathematically reduced phase-out zone. And if your MAGI crosses that $299,190 threshold, the financial benefit is entirely eliminated. We're talking absolute zero. These aren't just suggestions. They are absolute rigid cliffs. The expert report makes it clear that understanding your exact income trajectory is an implicit assumption built into this framework. Think about it. If you fail to accurately project your MAGI, maybe because of a surprise year-end bonus that bumps you over that cliff, you could unexpectedly lose access to the entire $17,280 benefit. Ouch. Okay, so beyond those income limits, we really need to nail down what actually counts. What exactly is a quote-unquote qualified expense? Well, the expert analysis gives us a very precise definition. These have to be reasonable and necessary out-of-pocket costs that are directly related to the principal purpose of legal adoption. This explicitly covers things like legal fees, required travel, which includes your meals and lodging, court costs, and those initial home study fees. But pay attention to the operative phrase here, out of pocket. You personally must be the one bearing the direct financial burden, and every single expense has to withstand the scrutiny of being definitively necessary for the adoption process to happen. But just as important as what's included are the explicit operational exclusions. The framework instantly disqualifies a few specific arrangements from being claimed. For starters, you absolutely cannot claim expenses for adopting a spouse's child. Surrogate parenting arrangements, those are strictly excluded too. Also, any expense that has already been leveraged for a totally different federal benefit, or funded by a local or state government program, or reimbursed by your employer, those are mathematically voided. No way around it. This rule is specifically designed to stop the systemic double-dipping of subsidized funds. It ensures this benefit is only covering genuine, unassisted, out-of-pocket burdens. All right, Section 3, Employer Benefit Interplay. Let's dig into the math of employer assistance. So the framework does allow you to exclude employer-provided adoption benefits from your taxable income. But, and this is a big but, experts mandate a very exact sequential analytical process to prevent illegal duplicate claims. Here's how it works. Step 1, you must legally subtract the employer benefits from your gross income. Step 2, you then have to subtract those exact same employer funds from your total pool of adoption expenses. Step 3, only the remaining strictly out-of-pocket expenses can be applied toward your $17,280 limit. You absolutely cannot claim the income exclusion and the tax benefit for the exact same dollar. It's just not going to fly. The firewall between these two mechanisms is absolute, which means your accounting needs to be incredibly precise. Now, there's a highly specific, kind of non-obvious exclusion rule buried deep within this framework that you definitely need to know about. If you happen to own more than 2% of your employer's corporate structure, like say an S corporation, you are legally barred from excluding these employer-provided benefits from your income. Actually, scratch that, it's not just a minor hurdle, it's a hard stop. This anti-abuse mechanism is intentionally designed to stop business owners from engineering tax-free loopholes for themselves under the guise of corporate adoption assistance. The framework heavily scrutinizes the ownership structure to ensure this benefit stays targeted at genuine employees rather than corporate stakeholders. Section 4, the Special Needs Exemption. Let's look at how to bypass those out-of-pocket requirements altogether. Honestly, this is perhaps the most powerful strategic insight we pulled from the expert report. Families who are adopting a qualifying child deemed to have special needs are granted a massive exemption. Basically, they are permitted to claim the absolute maximum benefit, the full $17,280, even if they incurred literally zero actual out-of-pocket expenses. It's a real game changer. The framework effectively assumes that a major financial burden is just inherent to the situation, so it instantly maxes out the benefit ceiling without forcing you to prove a single dollar of qualified expenses. It completely bypasses the rigorous, headache-inducing tracking required for standard adoptions. However, there is a catch. To actually access this exemption, you have to get an official determination. And the 2025 framework introduces a really crucial expansion right here. Historically, Only state governments had the legal authority to issue this special needs determination to unlock the max benefit. But starting in 2025, Indian tribal governments have officially been granted equal legal authority to make these highly lucrative determinations. This is huge. It represents a significant broadening of jurisdictional recognition within the financial framework, and it opens up entirely new legal avenues for families trying to qualify. Moving on to Section 5, Strategic Claim Timing Rules. Let's map out exactly when you can make these claims. Understanding how much you can claim is only half the battle. Now we have to deconstruct the rigid chronological rules dictating exactly when these claims can be legally executed. There's a stark juxtaposition between domestic and foreign strategies here. Domestic adoptions carry a much lower financial timing risk. You can claim expenses as they are incurred or the year after they are paid, even if the adoption ultimately fails. The framework recognizes your financial outlay regardless of the final outcome. Foreign adoptions, though, they operate on a strict conditional if-then rule. You are legally barred from claiming a single dollar until the adoption reaches absolute legal finalization. If a foreign attempt fails, your financial benefit is zero. This dictates entirely different risk management profiles depending entirely on the geographic origin of your adoption process. Finally, Section 6, Carry Forwards and Sequencing. Let's finish up by looking at multi-year rollovers. Because that $12,280 non-refundable portion requires you to have a tax liability to actually use it, you might not be able to absorb the whole thing in a single year. Well, the framework dictates a very strict timeline for this scenario. Year 1 is your initial claim. You are then permitted to carry forward any unused non-refundable portions for a maximum of 4 additional years, so years 2 through 5. But you've got to pay really close attention to year 6. When the clock strikes on year 6, any remaining unused balance hits a total dead end and is permanently forfeited. It just literally vanishes from the ledger. This makes accurately tracking the decay of your carry forwards absolutely vital. And right here is a critical sequencing firewall mandated by the new 2025 rules. Because 2025 introduces that highly desirable $5,000 refundable cash portion we talked about earlier, you might be sitting there wondering, hey, can I take my old unused non-refundable carry forwards from 2023 or 2024 and somehow convert them into new 2025 refundable cash? Well, the expert analysis is absolute on this. No way. Past non-refundable carry forwards cannot be retroactively converted. An old non-refundable credit remains locked as a non-refundable credit until it's either used against your tax liability or it hits that 5-year forfeiture wall. The sequence is entirely locked in time. So, what does this all mean for you? It brings us to the ultimate question you really have to ask yourself when navigating this system. Does your multi-year strategy accurately map the rigid per-child ceiling against the strict 5-year forfeiture firewall? Look, the 2025 framework is not merely a set of suggestions. It is a mathematically precise system of caps, exclusions, and chronological triggers. You need to recognize the timing disparities, track the decay of your carry forwards, and ensure your strategy aligns perfectly with these rigid parameters. Because in this framework, a single miscalculation can literally cost you the entire benefit. Thanks so much for joining me for this explainer. See you next time.